Welcome back to Gimme Some Truth. Today we have Sil and Keith in the booth along with myself, Clint, and we are going to dive into a little bit more about the market outlook piece that both of them wrote. And this isn't the first time that you guys have written, particularly Keith has written about currencies. I believe you write it all the time. And finally, I would say you're kind of in vogue this year, like all of a sudden, this whole story and this term now has come out. And I think it's really important to dive into why this term has all of a sudden become popular. De-dollarization is now the term du jour. Why do you think de-dollarization has kind of been the phrase that's gotten coined right now?
Well, first of all, I want to make clear that now that this is popular, I'm never going to write about it again. I'm going to have to find something even more obscure next year to write about. And I think the only reason I write about it is nobody else wanted to. But de-dollarization, I think there were a couple of things, one of which we talked about actually earlier in an earlier podcast, which is stablecoins, right? Things like that. The other thing is we noted in the past as well, before the presidential election, kind of late 2024, maybe Q3, Q4 2024, Federal Reserve banks that weren't the U.S. started buying more gold, and that led to less use of U.S. Treasuries in foreign reserve bank vaults, essentially. And so those are the two things that kind of happened. And then you couple that with kind of a swing in the value of the dollar. It was really strong end of 2024. It really hurt European non-U.S. assets at the end of 2024. And then in 2025, the pendulum really swung hard the other way. And so I think there are two things, right? You have de-dollarization in terms of reserve currency, and then you had de-dollarization as a trend in kind of using less of it in trade in some sense.
That's right. And still, I think one of the things that strikes me is there is a narrative from the Trump administration that they want a weaker dollar. So how much of this is the administration wanting a weaker dollar versus just the market forces are forcing this weaker dollar?
Well, I think ultimately it's always about the market, right? But I think there is also this perception for the first time in a long time that this administration is willing to tolerate a weaker dollar. And I don't know if they're always that explicit about it, saying, oh, we want a weaker dollar. I don't know if any U.S. president is ever going to really come out and say, oh, I want to tank the value of the dollar type of thing. But it's true that, making your currency competitive is, one way to potentially make your exports more attractive, right? And that's a tool that, perhaps historically in the U.S., we've been hesitant to use, in part because of the dollar's role in the global economy as the sort of global reserve currency. And maybe there's a sense that, that could be shifting, right?
Yeah, and Keith, I think that one of the things, too, when we saw a lot of the tariff policy, do you think that the tariffs had an impact then on how the U.S. dollar was viewed and perhaps the sort of rotation out of the dollars? Is that a potential narrative there?
Yeah, I mean, I think there was a sense of, loss of trust. But as we, already mentioned, this started well before the tariff policy hit. And I think a big part of it was the U.S. became a huge, U.S. Treasuries became a huge reserve for foreign, central banks, largely because of the global financial crisis. The U.S. there was a huge rush, and we can't kind of overstate how much, importance that had in this. And so I think part of this is still a natural shift away. I was just reading something that said, hey, if you look at percentage of U.S. dollar in, central banks' reserve funds, we're about 60%, which is where we were in the 90s, even, before the global financial crisis. So a little bit is still an unwinding from that. And I think as well, you saw with, the same thing happened to a lesser degree with COVID. There was a flight into safety, and the U.S. Treasury is that place. So I think there was a little bit of a move away from U.S. dollars that was just a natural rotation after those two big events. It may have been, decline of the U.S. dollar may have been accelerated by what we saw with tariffs, but I think it's part of a larger trend.
Yeah, so you're saying almost like it's not a de-dollarization, it's more of a normalization.
In some sense, yeah.
Yeah, because we're going back to more normal levels, whereas, out of the crises, you see the dollar spike in those situations. And still, when we rotate out of dollars, I mean, we don't just go to, other countries and other entities that are purchasing. They're not just going to, say, the euro. It seems like they're rotating out into perhaps precious metals. It's been a heck of a run in that recently, a big pullback recently too. But where do the assets go when they kind of leave dollars?
Yeah, well, that's an interesting point, actually, because there's been this narrative last year about, people are dumping treasuries, and, nobody really tells you, okay, what are they dumping the treasuries into, right? Where is this money going? And I mean, the reality is, and part of what I wrote about in the piece is, if you look at the numbers
we wrote together,
that we wrote together, excuse me. So your piece, Keith, you rightfully highlight that. I mean, de-dollarization, if you look at actual market statistics, I mean, it hasn't really happened in any sort of material way, not in a way that really matches the narrative that is, at the sort of height of the panic last year, people were talking about like the death of the dollar type scenario, right? It was kind of this nightmare, vicious cycle of, people dumping treasuries and the dollar weakening and so on and so on. But if you look at actual data, it's not really happening. Like Keith alluded to earlier, the dollar is still 55 to 60% of global reserves. So things have not really changed that much. We've seen a move into gold. Obviously, gold has been something that is, I guess, the role of gold in the global monetary system is I guess coming back to what it's been historically, right? This is new that gold is an important part of global reserves, but it's true that over the last few decades, maybe it hadn't been as prominent as it had been historically. So gold is coming back, but it's also true that the dollar remains the key global reserve currency. And part of the issue is you can't just decide tomorrow that you're going to put all your money in Swiss francs or Norwegian kroner because you think these are safe currencies in well-run countries or whatever. Because when you trade in size, if you're a large institutional investor or central bank, you need the depth of capital markets, right? You need the depth and the liquidity in the bond market. And it doesn't exist in, Norwegian kroner, right? You cannot go and trade in tens of billions of dollars easily in those markets, right? And so I think people kind of underestimate just how entrenched the dollar is in the role of the dollar is in the global financial system. There is no alternative. And, some of the issues you face when you try to diversify, they're mechanical. It's just the liquidity isn't there. The size of the market isn't there. And Norway and Switzerland, they're large, they have large trade surpluses. They're not going to start, expanding the size of their capital markets. They have no incentive to do so, right? So there aren't a lot of places for that money to go, simply put.
Yeah, and it's not going into cryptocurrency recently.
Not recently.
Fall of that. So we could see the big sell-off there, and that has not become the reserve currency as well. Now, Keith, when we talk about more portfolio construction, and if we do see the dollar continue to decline, how do you kind of manage that with portfolios, and how do you construct it? Are you buying individual currencies? Are you diversifying into other asset classes? How are you kind of playing this currency game?
Yeah, the first thing to understand is that every currency in the world is basically at this point designed to be worth less tomorrow. It may be a microscopic amount than it is today. So just buying currency isn't really a great bet. I mean, it will make you money in US dollar terms, but if you're living abroad or spending that currency, over time, the value of that is going to degrade. The U.S., we aim for a 2% inflation rate. And so every year, the currency, give or take, should be 2% less valuable. There are a whole bunch of macroeconomic reasons that kind of beyond our purview here, but just bear that in mind. So the best way is to invest in stocks and bonds outside of the U.S. that are unhedged to the U.S. dollar. It's one of the harder things, especially in the bond market, is to find foreign bond funds that are unhedged to the U.S. dollar. It's something, particularly for our international clients we do. And then foreign stocks. You may look at your portfolio on Schwab or, Altruist or Interactive Brokers or wherever, and you may see the value of something like FEZ, which is a European stock fund, or VGK, and it's listed there in dollars, but what it actually holds inside of it are European stocks that are priced in euros. And I always tell clients a story. When I started in this, I had one of those big Bloomberg monitors, and I could monitor the same stock on multiple exchanges. And one that I did was Hermes, the leather good company, because I had this wild plan that I would buy a share of Hermes and then one day be able to buy my girlfriend an Hermes bag. We're still waiting on that one, but Hermes has done pretty well. But what you would see is some days in, on the French market, I could see it and it would be flat, and then I'd see it on the U.S. market and it would be up or down. And that up or down is solely due to the change in currency. Traders are working to arbitrage that difference all the time. And so that is, in the long term, and it's something we across Walkner Condon, both on the international side and on the domestic side, do is we buy foreign stocks that are unhedged to U.S. dollars. And we've seen now in 2025, those returns were spectacular. It's really interesting in 2024 when we saw the opposite case, that the rest of the world's currencies declined. Actually, foreign stocks in their local currencies had pretty good years, but they were down, ever so slightly, the results didn't match up to that. They were still up ever so slightly, but, in local currency terms, they might have been up 14%. In USD terms, they were up 4 or 5% because of that currency swing. So that's, I think, the best way to look at it, not just buy and hoard dollars. And then depending on the client, precious metals, commodities are also a good way to handle, this kind of view of the market. So, that we may be seeing a decline in the value of the U.S. dollar. I did have one question for Sil. Sil, obviously we wrote the piece together, but you found this book that was kind of the center of the piece. How did you find it?
I think I randomly came across it on the internet, maybe on Twitter. I can't remember. But it was funny because it's really old. It's from 1968, and it was this book written by William Rickenbacker, I think was his name. Was an economist, and it was called "The Death of the Dollar," right? And what's funny is the book talks about a lot of the same themes that we're dealing with today, right? Is deteriorating trade conditions for the U.S., concerns about the role of the central bank in the U.S. and potential mismanagement. And these are all topics that, are still around today, right? And you could really take all the arguments that the author was using and really transpose them to today's environment, and they would work quite well. And, I guess the idea behind using the book as an example is to really emphasize that this idea of the dollar dying it's been around for a long time, right? It's not new, and it's a great story, but it doesn't always work out. And again, if anything, since 1968, the role of the dollar in the global economy has probably, pretty dramatically expanded. And the dollar is certainly not died by any means. But and it's funny because I think here in the team we've tended to highlight dollar weakness as a potential risk for investors, and I'm personally, I tend to think that long term the dollar is probably going to depreciate. And yet, I almost feel like in the piece, we almost had to kind of almost write a pro-dollar piece, not because our views have changed, but almost because like the pendulum has swung too far the other way in terms of investor sentiments, and people were, panicking at the value of the dollar when, I guess what we wanted to do is introduce a bit of nuance in the discussion, that ultimately it's not going to be all or nothing.
I just picture 1968 Keith that has the same outfit on, right, drinking wine, talking about how the dollar is no longer going to be the reserve currency. It just fits for me right here, drinking his glass of imported French Bordeaux and just going, the dollar, it's gone. That's fantastic. Keith would still hate gold in that situation.
Well, I have shifted a little bit on gold because actually that was one of the really intriguing things is if you look at what Rickenberger predicted for what you should invest in for the 70s, it held up really well. It was hard metals, commodities, those sorts of things, and avoid, a lot of the other kind of stuff out there. It was interesting. So I think, from our perspective, adding a little bit of alternatives, I prefer a more diversified basket of precious metals than just pure gold, I think, is if you're pressing me on it.
Yeah. And the key is, I think what you mentioned earlier is ultimately every currency is a bad investment, right, in the long term. And so try to look for productive assets to invest into is ultimately the key.
So I'll dig along from this, that Keith is now a copper bug. So I like that. I like that.
No, actually, the Bordeaux in my cellar, that's a good investment.
There you go. Never goes down until you drink it.
Yeah. Right to zero very quickly.
Well, thanks for joining us. Definitely check out the article in there. It's very well written. It's written in accessible terms as well for the average person to glean out a bunch of different points on there. And, join us for another episode of Gimme Some Truth in the future and leave us any comments. And, we'll answer some questions if you have some of those as well. So thanks for joining us. And we'll see you on another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.